Hey, what's up, everybody? What's up, everybody? It's your boy Chris. It's your boy Chris. It's another amazing episode of Financipation. This channel is all about making money. It's all about saving money. It's all about building generational wealth, and it's all about financially emancipating yourself from generational poverty. On this channel, everybody, I try to give you a six-figure MBA level worth of investing in financial knowledge for free here on YouTube. And the things that people typically spend hundreds of thousands of dollars to learn in grad school, I give it to you for free here on this channel. Also, before I get started, everybody, I want to give a shout out to one of my sponsors, Kilico Solutions. If you need digital marketing, or website development, or someone to essentially edit your YouTube videos, they are the best in the business at meeting all of your digital needs. All right, everybody, I received a question from somebody, and they were essentially asking me, Chris, what are the differences between index funds and ETFs? And this is actually something that I wanted to talk about because the last couple of weeks I've had a couple different podcasts about ETFs, exchange traded funds. And a person asked me essentially, what are the differences between the two? And if you're familiar with my channel, familiar with my content, you'll know that a very large percentage of my brokerage accounts and my retirement accounts are in index funds and they're in ETFs. And so for this particular podcast, is what we're going to talk about. What are the differences between ETFs and index funds and which one is better for you? So let's get started, okay? So index funds, as I stated earlier, I have a lot of financial content and a lot of YouTube videos in regards to what is an index fund, and you should definitely check out some of my videos on my podcast. An index fund, everybody, or a mutual fund is essentially a pooled collection of assets that invest in stocks, bonds, and other securities. So when you buy a mutual fund or an index fund, you essentially get a much more diversified holding in regards to if you instead decide to go with buying an individual stock or individual bond. If you buy an index fund, you essentially buy the entire bag. If you buy a stock, you only buy one very small portion of the bag. And the index fund as well also has a portfolio of stocks or bonds that are designed to mimic or to essentially match the composition and the performance of a financial market index. And this market index can be everything from hospitals to technology to real estate and to various other indices, okay? I, full disclosure, have index funds that have literally over 3,000 stocks inside of them, period. And if you're not familiar, index funds were started in 1975 by the founder of Vanguard, by a gentleman named Jack Bogle. And prior to 1975, when a person wanted to essentially get into index funds, what they had to do was they had to basically hire a financial planner, and they had to pay this individual exorbitant fees to essentially pick stocks and to pick indices for them. And when Jack Bogle came around, he said that's a terrible idea. He eventually created something that essentially absorbed all the stocks from a specific indice or from a specific technology or from a specific sector into an index fund. And what it did was it allowed to make the market that much easier for anyone to become a regular investor. If you invest into a mutual fund, which is passive, which is actively managed by an individual, you are essentially paying vastly more money for an inferior product. Whereas if you invest in a passively managed index fund, which is what I invest into, typically speaking, you're going to make more money over an actively managed mutual fund at 95% of the time. So once again, everybody, mutual funds, they're designed to beat the stock market, whereas index funds are supposed to just match the stock market. And Warren Buffett has said on numerous occasions that over a 15-year period, even he himself cannot beat the stock market. So if Warren Buffett can't beat the stock market, why in the world would you be giving your money to some mutual fund manager to try to beat the stock market? And what it boils down to, people, is this: people that invest in mutual funds essentially lose money over the long term 95% of the time, whereas those of us who invest in index funds, we make money. So pros and cons of index funds. First and foremost, index funds have extremely low operating costs. They also, according to Financipation.com, Fidelity.com, and things of that nature, index funds are some of the most flexible trading accounts that you can potentially purchase and buy into. I, for instance, have an index fund that has over 2,000 to 3,000 stocks inside of it. Another thing I love about index funds is that they are extremely hands-off and they're extremely good for us long-term investors. I'm a mechanical engineer. I'm a husband. I'm a father. I like to kickbox. I want to honestly get back into mixed martial arts. So I don't have a lot of free time. As a result of that, I like index funds because I can essentially invest my money into them and literally walk away. And 15 to 25 years later, I can come back and literally they have more than quadrupled as far as what I originally put into them. So you just invest a couple dollars every paycheck. You basically let it, you don't touch it. You basically just let it expand for over the decades. And by the time you're ready for your retirement, voila, you have basically created essentially a very large nest egg. So check out my podcast, everybody, on how index funds can make you millionaires. Now, next, what exactly is an ETF? An exchange traded fund is a type of pooled investment security that operates much like a mutual fund. Typically, ETFs or exchange traded funds will track a particular index, a sector, or a commodity like technology, like healthcare, or like real estate. And unlike index funds or mutual funds, ETFs can be purchased and sold through the stock exchange just like a regular stock can be sold. ETFs in general, everybody, are more cost effective and they're more liquid than index funds. And they also tend to be slightly more flexible depending on what you're trying to buy into. So some of the pros of ETFs are the fact that they have extremely low operating costs. They also have very flexible trading. I also have an ETF, by the way, everybody, through Vanguard that has over 4,000 stocks in it. By that measure, I am so diversified with that account. I literally have almost basically purchased the entire stock market just from buying that one ETF. Another thing that I love about ETFs is that they are very transparent. I can literally Google my year-to-date returns over my 10 to 15 year-to-date for returns of my ETFs. And within 2 clicks of a mouse, I can find out what they are through my ETFs. Once again, everybody, check out my podcast on how ETFs can make you rich. Next, ETFs versus index funds, and what are the differences? In general, everybody, ETFs and index funds are both great for investors and experts alike. So differences. One of the biggest differences between ETFs and index funds is that ETFs can essentially only be purchased and traded from 9 a.m. to 5 p.m. Monday through Friday. Whereas index funds, particularly the ones that I buy, I can literally buy these things 24 hours a day, 365 days a year. Another difference between index funds and ETFs are intraday trading. So if you're the type of individual, and I do not advise you to do this, but if you're the type of individual who wants to do intraday trading or whatever, once again, I highly advise you do not do this. But if you're the type of person who wants to be a day trader and you want to essentially buy stock and sell it, ETFs are basically your cup of gold because that's essentially the way you can do that. Whereas the index funds is not as easy or as intelligent to do that. Having said that, if you follow my channel, you are aware of the fact that because I am a long-term investor and I do not do day trading or any of that kind of stuff, I am not a fan essentially of buying your stocks at 4 o'clock, at 9 o'clock in the morning and then selling them at 4 p.m. because the sky is falling. You heard something on C-SPAN or whatever. I don't do that. Having said that, if you do want to be an intraday trader and you do want to essentially be a day trader, ETFs are a little more, it's a little easier to do it with the ETF versus the index fund, okay? Next, ETFs are slightly more tax efficient than index funds. So depending on the type of ETF that you're going with, many of them are slightly more tax efficient than index funds, depending on which ones that you buy. But once again, everybody, this also depends on whether you do intraday trading or not, and whether or not you are a day trader. And it also depends on what states that you live in. Another difference between ETFs and index funds is that they have minimum investments required. So for instance, depending on your brokerage account, in many cases, ETFs can actually have a lower minimum investment than index funds because all you need is to buy one share, and some brokerage accounts even allow you only to buy one share of fractional sharing. Whereas with index funds, once again, depending on the brokerage account that you're going with, some brokers put a minimum amount in place. So if you only have a very small amount to invest, some people will choose ETFs. But once again, everybody, this literally depends entirely on your brokerage account. For example, I am with Fidelity. That is one of my brokerage accounts, and Charles Schwab is the other. Fidelity, however, is my preferred brokerage account. And with Fidelity, I can literally purchase index funds or ETFs for $1. So this quote unquote difference is non-existent for me. So the minimum investment amount required may or may not be applicable depending on which brokerage account that you go with. Next, another difference between ETFs and index funds are the capital gains taxes that you pay. Because of the way that it's structured, ETFs can be slightly more tax efficient than index funds by their very nature. So for instance, when you sell an ETF, you typically sell it to an investor that buys it. The government wants to be paid a percentage of what you make because the government always wants their money. It's as simple as that. These taxes / government fees are called capital gains taxes, and the federal government will literally always get their money. They're not stupid, everybody. They're just slow. Whereas if you want to get a tax out of an index fund, you have to essentially redeem it from a fund manager. When the index fund manager sells it, you get hit with the capital gains taxes, and usually these taxes are slightly higher for index funds than it is for ETFs. Granted, this happens less, however, with index funds, but in general, from a tax perspective, ETFs generally have the upper hand over index funds when you start selling ETFs or selling index funds. But once again, everybody, this gets me back to my original point. I am a long-term investor. I don't buy my stocks, I don't buy my ETFs, and I don't buy my index funds and sell them. I hold them for decades. So if you hold your index funds and your ETFs for decades, and you basically are a long-term investor, you are going to pay a lot less in capital gains taxes. Having said that, if you want to decide instead, however, to be a short-term investor and you're buying your ETFs and you're buying your index funds and you're selling them because you're a day trader, you're going to pay a lot more in capital gains taxes, okay? Which is another reason why I say be a long-term investor. Do not be a short-term investor. Before I go any further, everybody, please hit that notification bell so you know when I drop new content. Please like, please comment, please share, please subscribe. I'm giving you essentially an MBA level worth of investing and financial knowledge for free here on YouTube. And I love this, and I love basically spreading the ministry of financially emancipating yourself from generational poverty. Next difference I want to talk about is this: the cost of owning ETFs and index funds. ETFs and index funds are extremely inexpensive and they're very cheap to own from an expense ratio perspective. So I have an index fund through Fidelity that costs literally $0, period. I have an index fund through Fidelity that has an expense ratio of 0.01%, and I have an ETF as well that has an expense ratio of 0.02%. So in general, everyone, you can easily find index funds and ETFs that have expense ratios of under 0.05%. Another thing to look at is whether or not the brokerage is actually charging you a trading commission, because if they're doing that, that's more money they can potentially charge you. So if the broker does charge a commission for the trades, essentially people are going to hit you with a flat fee when they sell your ETF or your index fund, which can eat into your returns. But once again, everybody, this gets back to my original point. If you are a long-term investor like I am, and you essentially buy your ETFs or you buy your index funds and you don't sell them, you literally hold them for decades, you don't have to worry, once again, about a broker charging you for commissions, fees for their trades. Essentially, everybody, hold your stock, buy your index funds, buy your ETFs, and essentially hold them for decades, okay? Simple as that. Next, what do index funds and ETFs have in common? They actually have a lot in common, everybody. First and foremost, they're extremely diverse. Both index funds and ETFs, once again, you can literally buy some that have sectors that have over 1,000 stocks inside of them. I once again have ETFs and index funds that track the 500 best stock markets in a particular sector across technology, across healthcare, across real estate, across artificial intelligence, and so forth. I also have ETFs and index funds that have over 2,500 stocks rolled into them. So both ETFs and index funds are extremely diverse. Next, another thing that index funds and ETFs have in common, they have extremely low costs. So I talked about this a little bit earlier, but index funds are passively managed, which means that their costs are extremely low because you're not paying anybody to essentially manage them. ETFs, for the most part, are also passively managed. So in general, their costs are also extremely low. Next, the next thing that ETFs and index funds have in common is they have extremely strong long-term returns. So for long-term investors like myself, passively managed index funds outperform actively managed mutual funds 95% of the time over a 15-year period. ETFs also tend to do quite well and outperform mutual funds over that same 15 to 30-year period as well. So if you're, once again, a long-term investor like my wife and I, ETFs and index funds are essentially worth their weight in economic and in retirement gold. In closing, everybody, which ones are better? So earlier, my buddy asked me, which ones are better, Chris, ETFs or index funds? And honestly, people, after doing the research, I'm gonna be real with you. You honestly will not go wrong with either one. If you take a look at my wife's and my portfolio, literally, I would say anywhere from 80 to 90% of our investments are pretty much rolled into some version of an ETF or an index fund that tracks the total stock market, period. And ETFs and index funds are phenomenal investments for anyone. And I would highly, highly advise all of my listeners and clients to invest a large percentage of their brokerage and retirement accounts into both, into ETFs and into index funds, for all the reasons that I talked about throughout this podcast. People, you really can't and you really won't go wrong with having a diversified portfolio that is loaded with ETFs and index funds. Both ETFs and index funds, in my opinion, should be an instrumental tool in helping you build generational wealth and helping you financially emancipate yourself from poverty. It's as simple as that. So in closing, everybody, this channel is all about making money. It's all about saving money. It's all about building generational wealth, and it's all about financially emancipating yourself from generational poverty. You can book a one-on-one session with me at any point. The link in the description will be below. And once again, everybody, I'm not giving you financial advice. You must make your own educated, responsible decisions based on the research that you do, okay? Please follow me at my website at www.therealfinancipation.com. Please follow me on Instagram at thereal_financipation. My Spotify page is Financipation, just like it's spelled on my shirt, just like it's spelled back there on that sign. My TikTok is Financipation as well. Follow me there. My Facebook page is Financipation. And check out my digital products as well, and check out my blog where I go into detail, a lot more detail about HSAs, Roth IRAs, 401ks, and things of that nature, okay? So that, everybody, it's your boy Chris. I'm out. Please like, please comment, please share, please subscribe. Please hit that notification button so that you know when I drop new content. And thanks to Kilica Solutions for all these dope graphics. I truly appreciate it. It's your boy Chris. I'm out. Peace.